Hey everyone, welcome. My name's Robbie and this is Robbie in Manila. Now today we have an amazing video for you. I mean, wow. This is gonna be a great one because we're talking about M1 Finance. We're gonna go through a whole tutorial about M1 Finance. So if you're interested in setting up M1 Finance, we're gonna go through how to start an account and open an account. If you're interested in learning about pies, if you're interested in how to find the first stocks or first investments when you start out, then this is gonna be the video for you. Now I'm gonna put some timestamps on the bottom, so if you've already set up an account and you wanna skip forward, you can totally do that. But just know that we're gonna go through pretty much everything you need to know when you start an account here today in this video. So let's go ahead and let's get started. Okay, so are you ready? Because we're gonna start right now with the first step, which is setting up an M1 Finance account. Okay, so the first step is pretty self-explanatory. You need to go find the app. So let's go ahead. I have an iPhone, so I'm gonna go to the App Store. I'm gonna go search M1 Finance, and I'm gonna download the app, pretty simple, and then I'm gonna launch it. Okay, so I got the app open, and I'm gonna go through this pretty quickly, but if you need to, go ahead, press pause while you're filling things out. Also, if you've already done this, then check the timestamp and go ahead and fast forward through the account opening part. But I see here it says build your portfolio. I'm gonna go ahead and continue going through, and it's gonna ask me what type of account I want. So at the top, you'll see join M1 Plus. So what does that offer? Well, it's gonna cost a bit of money for M1 Plus. Right now with M1 Finance, you can only have one trading window for the day. So if you buy a stock, it's going to trade basically later in the day. So it's not like you can trade a stock with M1 Finance. It's not a good place to basically day trade because you're not getting active prices at that moment in time. You're getting like a stock price at the end of a day. But if you have M1 Plus, then you have afternoon trade windows as well as morning trade windows. So there's two trade windows instead of one. There's also some other benefits. I don't want M1 Plus. For me, the benefits aren't good enough for me to go ahead and get it, so don't really care about it. That's up to you if you want it, okay? Maybe you like it, maybe you don't. Maybe there's some certain features that you need. For me, I don't need it. Then there's the account that I need. So do you need a retirement account? Do you need some other type of a specialty account for yourself, like a joint account or something like that with a spouse? So that's gonna be up to you. For me, I'm just going with a taxable brokerage account. That's like a simple account. There's no limits. I can put money in. When I sell a stock, I pay capital gains on it, and pretty easy stuff. You know, there's Roth IRAs available. So go ahead and figure out what you want, and then go ahead and click it because that's the first account you'll be building. And then next, of course, you need to put in your information. So this is all private stuff. I'm just gonna skip past this. I don't want you seeing my social. Okay, so personal information is all filled out. Now, the next thing I need to do is build a portfolio. Now, okay, M1 Finance uses the term pies. And a pie is like a great way to visualize how your stock allocation is made up. So basically, it's like a pie. So each slice of a pie is a certain percentage of the money that you have in your portfolio. If that's confusing, we're gonna go over that in a minute. So just let's keep going here. What you need to do is you need to create a pie to start out. So I think that probably the best and easiest thing for you to do might be to just pick an ETF that's a diversified ETF. If you don't know what that is, I will explain that in a second. So what I would do if it was me and I was just new to investing, I just put maybe VOO, which is a Vanguard ETF that tracks the S&P 500. So you can go ahead and you can do that. For me, I don't know, I'm just gonna actually go over here and I'm going to search for stocks and I'm going to see Adobe. Nah, I don't really want Adobe. Coca-Cola, there you go. I'm gonna go ahead and add Coca-Cola and I'm just gonna continue. Of course, 100% of my money is gonna go into Coca-Cola when I add money to the account, but I'm gonna be changing this around anyway, so just remember if you add money to this account, it's going to go directly into whatever you put it into. So for me, it's gonna go into Coca-Cola, but I'm going to try to change my pie around before that happens. So the next thing you need to do is you need to connect your bank account. So go ahead and go to the connect bank account area, and I'm gonna skip this part because I don't want you to see my bank information. So go ahead and try to do this if you're ready to fund your account. So a few things to know about this. You can either directly link it through your whatever bank account you have. So they use something called Plaid, and Plaid can technically, if your bank has a subscription with Plaid or whatnot, or a relationship, then you can use Plaid to fund the account. Now, if you don't have that, there's a possibility that you will need to just go ahead and do like microtransactions. And so what that means is you're gonna, if you don't have Plaid availability with your bank, you're just gonna go in and you're gonna say that you wanna do microtransactions or micro deposits. And what's gonna happen is M1 Finance, within 1 to 2 days, they're gonna put some money into your account, and that's it. So you're gonna see this money come into your account. It's gonna be like a few cents, right? And then you're gonna have to go into M1 Finance and you're gonna have to put in which different transactions you saw. And then that will verify that that's your account. So one of two ways, either Plaid or those little micro deposits. So let's go ahead and move on. I'm gonna skip forward because I'm gonna enter my bank info and then we'll go from there. Okay, so hopefully you were able to get your bank account connected and everything's good. Now, for me, I tricked you. I already have money in the account. I have $100. I just put in $100 just to start. And I wanted to show you what you can do with $100 when you're starting out, which is the minimum amount that you need to open an account with M1 Finance. So here's the thing. When you start with this company, you have to manage your pies. And I want you to basically understand how pies work because it's really the fundamental basis of the app. And if you don't understand it, it's gonna be really hard to understand the whole concept of everything going on. So, for example, let's say you have another app. Let's say you have Robinhood, or you just have a Charles Schwab account. The amount of money that you have in different stocks, that's just another way of looking at it as a pie. So basically think of a pie chart, and a pie chart has different slices. So for example, if you have 10 stocks, and each of those stocks you want to have an equal weighting, then you could have 10% in each stock. 10% of your overall portfolio can be in each stock. So for example, I just have $100 in this. So to make my portfolio an equally weighted portfolio of 10 stocks, all I need to do is put 10% in each of those stocks and have 10 stocks. That will equal 100%. What does that mean? So I could have $10 in Coca-Cola, $10 in Home Depot, $10 in Starbucks, $10 in Apple, $10 in Facebook, going on until I hit 10 stocks, each with $10. That means that they're all equally allocated between 10% positions, equaling $100. Hopefully that makes sense. So basically, if you think of it as a pie, it's gotta equal 100%. You can put 100% of your money into one stock, and that would be a 100% allocation. You could put 50% in one stock, 50% in another stock. So this is what I'm saying. You can combine and basically cut up the amount of money you have and look at it and visualize it as a pie. That's how this whole app works. So the next thing we want to talk about is how to manage the pie. So if you see here on the bottom right, I have all my money's in Coca-Cola right now, or most of it, $99.34 is in Coca-Cola. So if I hit manage pie down here, there's a few things that I can do. The first thing I want you to see is, you probably have opened up your pie already and created a pie. So the first thing we want to talk about is edit pie. Okay, so you see up here on the top it says stocks, and so what we can definitely do is we can just add a portfolio of different stocks. If you're interested in only buying stocks, trying to beat the market, and really getting interested in understanding about how to invest in individual stocks and stock picking and things like that, great. You can do so here on the stocks tab. But if you want to take a look instead at funds, you can also do that. And so what happens with a lot of people is that they have some money maybe in stocks, but they also have some money in funds. And by the way, I have a great video. Well, I think it's great because I made it, but it's called, it's about diversification and how much money you should have in different stocks and how to create something called a core and satellite portfolio. I will link that right here, so take a look at that if you want to. I'll also link it at the very end, at the end screen of this video, so take a look if you want. But it really explains what I'm talking about here. But what you could do is you could basically have a portion of your pie in a fund. That fund is diversified. So just for example, I'm gonna type in VOO. Well, actually it's right here already. So VOO, I'm gonna click it. So VOO is an ETF, and it's an ETF that tracks something called the S&P 500, which you've probably heard before, and if you have not, the S&P 500 is basically the largest 500 companies in the United States based on something called market capitalization. So just think of it as the biggest companies. So the largest company in the S&P 500 is Microsoft, because Microsoft is the largest company in the US based on its market capitalization. It's over $1 trillion company. Then you have Apple, right? And then you have, so these are the companies that are the highest weightings in the S&P 500. Then you have the smaller companies going down the line. So as you get a little bit smaller, like instead of $1 trillion company, maybe you have a $30 billion company like Chipotle. So then all of these companies are in the S&P 500, the top 500 stocks in the US. So by just owning this, you have a diversified ETF. And this is what I'm trying to get across, is that's a way to kind of look at this. So this is how much money this ETF costs, $285.37. If you take a look right there. How much is it up today? Well, actually yesterday it was up $1.94, which is 0.68%. If you kind of scroll down, AUM is assets under management. Do you need to know that? Not really. I mean, it's not really important, but 139 billion in assets under management for this fund. How many people are invested in this fund, have their money there? The expenses for this is 0.03%, dirt cheap. I mean, it costs basically nothing. So don't worry about the expenses in this. And by the way, something great about this M1 Finance app is the fact that they do show you the expenses. Like for example, in Robinhood, I don't believe that they even show you the expenses, and that's an important part of this. So you should know how much money a fund is charging. And something that you should also know is that by putting money in this fund, that 0.03% does not come out of your cash. Like you don't have to put extra money in to pay for that. It just comes off of your rate of return. So basically it's cooked into the ETF, okay? Then you have the dividend. So the dividend on this is $5.34 for every share, and that equals 1.87%, okay? So then if you go down, you can see things like news. So if you want to see just different news, each of the stocks, or most of the stocks, have news available. There's price history. So here we can see the 52-week range is between $200 was the lowest this ETF has been, up to $311. The 1-year return of this ETF is 4.42%. So this actually is positive over the year, and it's been a crazy year. So, and a year meaning 365 days. So that's actually great. And then the 2-year annualized return is 5.96. The 5-year is 7.62. So if you had bought this 5 years ago today, you would be up 7.62%, which when I'm filming this is actually a really great rate of return considering what's happened in the past, few months with the whole thing that I don't want to mention because I don't want to get demonetized. So up at the top right, there is a chart. So you can go ahead and you can look at the chart. So if I flip the screen here, the chart is basically a chart showing 6 months, but if you click on the bottom right, on that 6M, now you can make it a year if you want to, and you can see the price history for the past year. You can see it for the past 5 years. So that's great if you want to see the price history of this stock. And then if you actually hover over it, it's going to tell you how much the return has been over that 5 years, because I'm in the 5-year view right now. So it'll tell you how much on each of those dates, how much of your rate of return is. Of course, back in February, you had a 62% rate of return, and then boom, only 18%, and that's because of what happened actually less than 18%. And that's because of what happened with the economy and everything that's happened lately. But it's good to know and good to see and good to visualize what's going on in the market and with this ETF. Okay, if you want to add this to your pie, you can. So I'm going to go ahead and I'm going to try to do that. So I'm going to hit add to pie, and then I'm going to go back. I hit add to pie and it says remove from pie. So add slices. I'm going to hit done. So now I added VOO to my pie. Okay. Now I have to change the percentage that I want in VOO, meaning that I have all of my money right now in Coca-Cola, so I need to reduce some of my Coca-Cola and I need to add some Vanguard. So what I want to do is I want to keep this Vanguard at about 50% of my portfolio. Again, because I'm going to make this like my core and satellite portfolio. So my core, the core of my portfolio, I'm going to add to this S&P 500 ETF. So I'm going to put 50%. And then Coke, I want to make 50, actually, Coke, I only want to make 10%, okay? So there we go, save. And now, well, actually, sorry, you have to, I have to add more, so I'm just gonna make it 50 so we can keep going with the tutorial, but I'm gonna reduce Coke in a minute. Okay, so now we're back. We're back in the add slices part. So let's continue understanding what's going on with the slices. Let's go to the expert pies. The expert pies are something important for you to understand. So there are different ways. This is actually what's great about M1 Finance. When you're starting out, you don't really understand how to basically chop up your pie, or wherever you invest, you don't know how to put money into different places, right? How much money should you put into this one stock versus this ETF? So by going with an expert pie, it's kind of pre-made for you, it's predetermined. And so you can decide if you want an expert pie or not. Now let's go through and kind of understand what the expert pies are. I just hit general investing. So let's first look at ultra conservative, okay? So we're gonna click ultra conservative. Now, someone who's conservative is oftentimes older. They have a very low risk appetite. So if you're younger, you probably don't care about being ultra conservative, but let's take a look at this anyway to understand what's going on in here. So there's 6 holdings. They're all ETFs. The expenses for this overall pie that is created by M1 Finance is 0.13%. Is that high? Well, it's fine. It's not that bad. It's higher than the VOO that we just saw, which was 0.4%, but no problem. Dividend yield 1.85. Of course, the risk is low. And then you can see the 1-year return is 1.57, the 3-year and the 5-year. So the returns on this are quite low. And of course, that's because you're not taking as much risk. So in investing, you have to take risk to try to potentially have a higher gain. So this is going to basically take away from the potential of having, maybe like double-digit returns for having something that's going to be more steady. And now at the bottom, you can see the methodology, which don't worry about this yet, but let's go up and I'm going to show you the targets. So up on the top, next to details, it says targets. So here's what's in this fund. So the majority of this is in something called the iShares 1 to 3 year treasury. Okay, what does that mean? Basically, it just means that it's investing in short-term bonds. So bonds with a duration of 1 to 3 years. If that's confusing, don't worry about it. Basically, these are conservative bonds. Okay, bonds have less risk than stocks, generally speaking. So this is actually investing in very conservative bonds. And then there's some other bonds that are a little bit less conservative. There's also a little bit of stocks in here. So when we think of the pie, and this I think is a good example for us, the pie is, if you see I'm clicking this green part right here. So that's the largest part of the pie, the largest slice of the pie. It's 82%. So, and that's that iShares, the very conservative part. But if we go and we click on this other piece of the pie, which is a Vanguard fund. Actually, I want to go to this one. So if we click this one, you see this is only 6% of the portfolio. So it's a small amount of the portfolio, and it's a small slice of the pie. But it still has a bit of risk. So while it's not a high percentage of the portfolio, this is a more risky investment because this invests in smaller companies that are stocks, smaller stocks. They're smaller companies. So you're not going to get the huge companies like the Amazons, the Facebooks, the Googles. You're going to get smaller companies, likely that you might not have even heard of before. And that's not a bad thing because what this is doing is it's allocating your money correctly for someone who's ultra conservative. But now let's look, instead of being ultra conservative, let's go to ultra aggressive. And let's see the difference here. So we see the details, the holdings, there's 7 holdings. The expenses are actually lower for this, 0.05. The dividend yield is 2.14. The risk is medium. Now look at the difference in the return here. So the return is negative 15%. Now we just looked at the ultra conservative return of a little over 1%. Huge difference, right? So this has not performed well lately, and it's because this is taking more risk. And in this moment in time, with what's going on with the market, there has been more risk, and the riskier investments have not panned out. Now, holding on to this may allow you to have a higher return later, or it might not. So that's up to you if you're going to take the risk, if you're okay with taking that type of risk. So now let's go down to the targets and see what this is invested in. So the first thing you see is VOO, which I mentioned before, which is just the general S&P 500 ETF. So there you go, we have VOO. We can see we've already kind of looked at VOO, so let's get out of that. But let's see again, now we have the Vanguard Small Cap, which is what was in the other one. But now what's interesting about this? So you remember the Vanguard Small Cap ETF was in that ultra conservative, but it was only 6% of the portfolio. Here it's 13%. And then if you have this other one, 9% is in mid cap. And so these are more geared towards actual stocks, whereas the other one was geared mostly, almost all of it was in bonds, and bonds have less risk. So hopefully that makes sense. That's in the general investing area. So now let's go to the next one. So you plan for retirement. Now what you can do is you can say, when do you want to retire? What year do you want to retire in? There's 2 options here. You can actually type it in, and let's say you want to retire in the year 2040, 20 years from now. You can go ahead and you hit that, and it's going to show you an aggressive 2040, a conservative, or a moderate portfolio. Let's just hit the aggressive, and you'll see what's in here. It's 16 holdings. We've got everything here. The 1-year return is down 14.53%. So let's go and let's hit targets just quickly to see again what this is invested in. And as you can see, it's invested in, this is the developed markets ETF, so it's gonna be an international, not domestic, not companies that are in the United States, but Canada, Europe, Pacific, but in developed markets, okay? And so this ETF, or this pie is invested in different ETFs that are going to be also a little bit more aggressive, but what happens with a lot of these, as you get closer to retirement, it gets less maybe aggressive potentially. Okay, so that's plan for retirement. Let's go to responsible investing. Just so you know, this is good to know. If you're interested in socially responsible investing, they do have this option here. It's a great thing. I mean, a lot of people really care about socially responsible investing. There's one drawback of this, and that is, if you take a look at, I'm gonna go to responsible investing on the bottom. There's a little bit higher of an expense ratio. It's 0.38%. So that's more than the other, let's say the one that we saw before, the aggressive portfolio. It had like a 0.5% expense ratio. So this is, over 5 times more, but it's still, it's a little high these days with the crazy low expenses. It's a little high. But that's what happens. So having a socially responsible investment portfolio, sometimes it just means you gotta pay a little extra for the fee. It's not a crazy fee. I mean, back in the day, fees could have been like over 1, 2, 3%. There's even 5% load fees back in the day. So having a 0.38% is not that bad, but just know that it's a little bit higher than you could probably get in some other places. There's also income earners, so if you're interested in something, they have both conservative, so a bank balance sheet might be a little, well, actually that's not conservative. It invests in mortgage-backed securities. Now let's take a look at it. And if you know what mortgage-backed securities are, there's this Vanguard mortgage-backed securities fund. So it invests in that. Now the price history of this is actually up 3.13% for this particular ETF. And if you want to look at the bank balance sheet, it's up 7.25%. So this is actually done very good, especially with what's going on lately. So that's a great fund for some people. It's probably more defensive maybe with what's going on. It's not invested in stocks, which have not done so hot, but in mortgages. However, there could be problems with the housing market, of course, maybe in the future, who knows? And in that situation, it could have a negative effect. Next up, we'll see, just going through here real quick, global dividends. So if you want stocks that are both in the US and outside the US, this is a global dividend fund, and it's going to invest in stocks that basically are growing their dividends or at least pay dividends. The dividend yield on this is 3.74%, but again, the expenses are a little high, 0.29%. And so these are all, of course, different things that are geared towards, they're pies that are geared towards creating and generating income for you. So next up, hedge fund followers. So a lot of people love this part, and this is good, but there are some drawbacks I want to make sure that you understand. So for example, Berkshire Hathaway. Berkshire Hathaway, the one, the only, Warren Buffett, the Oracle of Omaha, the man. He is the one who is, CEO and chairman of the board of this company, and he is an amazing investor. So people people, of course, like to learn or try to invest like he does, right? So they are trying to mimic what he's doing in this fund. However, this fund does not completely encompass all of the companies that Berkshire Hathaway has, because there are some private companies that Berkshire Hathaway owns that you can't even get in here. There's also joint ventures and things like that that you're not going to get in this. So it's not 100% what Berkshire Hathaway is going to be investing in. Warren also likes to invest in certain interesting things like preferred shares and things like that. So there's all sorts of things that you're not going to get that Berkshire Hathaway does invest in. However, this is going to, if we hit targets, you're going to see it's showing some of his largest positions. Apple at 37% of this whole portfolio is an Apple. Bank of America, Coca-Cola, American Express. So these are these different allocations in this pie, and it's supposed to track what Warren Buffett's doing. Again, just be a little cautious. You have Greenlight Capital, David Einhorn. He's like a hedge fund manager. He's like a titan, hedge fund titan. Icon Capital, that's Carl Icahn, another titan in the industry. Now, Pershing Square, this is actually a really good one for you to understand how you're not exactly going to be investing with what Pershing Square and making the same return as Pershing Square. And I'll show you why. So Bill Ackman is the hedge fund manager of Pershing Square. He's a baller. He's a hedge fund titan, and he's had a great track record, and he's had bad years. Lately, the past maybe 2 years, he hasn't done so great. But this year, and actually last year, he's doing pretty great. So what he did was he created a hedge, and the hedge basically cost him a few $1 million, maybe $20 or $30 million. But what it did was it assured him that if something happened to the market because of what his fears were with what was potentially going to happen, that he was going to make a very substantial gain. And guess what? It paid off. So he made $2 billion something dollars. But you don't get that in this, because this is only investing in the companies that this company is investing in. The only way to basically to basically benefit from what he has done is to be an actual shareholder inside the fund. This is just trying to mimic what he does. And so you'll see QSR restaurant brands, Lowe's, Berkshire Hathaway, Chipotle. So these are the stocks that he invests in his funds, but these other things that he does, like the hedge, you're not gonna get in this. So unfortunately, because of that, you're down 21% for the year. Whereas if you were in his actual fund, you would not be down 21% for the year. You might actually be positive. So something to remember here. I like the hedge fund follower thing, but I just want you to be, I want to caution you about it, basically, is what I'm trying to say. Go to the next thing. So just stocks and bonds. This is pretty simple, okay? So if you want just an ETF with stocks and an ETF with bonds, this is how to do it, nice and simple. So if you go to M1's 90-10, 90 is how much stocks, so 90% stocks, 10% bonds. So there's only 2 holdings, the expenses is 0.08. This is like such a simple fund and, you know, pretty good. So if you want a little bit of bonds and mostly stocks, then this can help you out. You'll see the targets are Vanguard, hold on, this is loading. Vanguard Total World Stock Index Fund. So this is basically, it's geared towards stocks, international and domestic and developed market stocks. Globally, it's a huge fund with many different stocks, things like that. This is a popular fund. And then the Total Bond Fund. So you have some stocks and you have some bonds. Depending on how much risk you want to take, you can go with one of these. You could say I want a 90% of my money in stocks, 10% bonds. Maybe you're a little less risky. Maybe you want 50% stocks, 50% bonds. You have the option in these pies here. Finally, at the end, you have other strategies. You have cannabis pie. I mean, if you're interested in investing in a fad, then go ahead, do it. But I don't recommend, I'm not recommending anything. You do what you want, okay? But for me personally, no thanks. Let's hit it. How's the cannabis pie doing? It's got 4 holdings. There's no expenses, good. But guess what? 1 year return, negative 72%. Bloodbath, right? Just, I will caution you, when you think something is going to be the best thing since sliced bread, it's probably not going to be. Basically, investing smartly, doing what people have done that's been proven strategies for the long term, that's a great way to invest. Investing in some new type of thing that might be a fad, that probably is a fad, probably not the best way to invest. Okay, get off my high horse now. Some other things here just to look at, global growth. So global growth, this has 4 holdings. This is actually down 4.24%. And this is going to have different global companies, and it'll have ETFs that in those ETFs have different global companies. So the first and largest one is the Charles Schwab Large Cap Growth ETF. So this is investing in big companies, large cap, so they're giant companies, and they're what you would consider to be growth. So they have a lot of growth potential. Maybe they don't pay many dividends. So as you can see, because growth companies don't usually pay dividends, they usually reinvest the money that they make as profits into the company instead of giving it to you as a shareholder. This only pays 0.71% as a dividend. And as you've seen, some other high dividend ETFs were paying as high as 3%, right? So this is lower, but on the flip side, this fund is supposed to try to get you to at least hopefully grow your money at higher returns and not care as much about the income that comes off of that. There's also the iShares. Anyway, so there you go. That's some of the different things. And then those are the expert pies. Finally, you have the watch list. If you want to take a look at the watch list, you can create your own watch list. If you want to keep up to date with different stocks, this is a great way to do it. Put it in your watch list. Finally, you have my pies. So you can create different pies and you can find them all here. So let's go to stocks real quick. Now we've gone through pretty much all the different pies and things like that, but let's look at understanding how to understand stocks with this app. So what I want to do is let's go to, you know what? Let's go with the man, the myth, the legend, Warren Buffett. We'll hit Berkshire Hathaway, Berkshire B. Berkshire Hathaway is $177.99 per share. Remember, this is Berkshire B, not Berkshire A. Berkshire A is a few $100,000 per share. So this is a different share class, but it's still Berkshire Hathaway. As you can see, there's actually no recent stories here, so okay, you know what, fine. Not the best example. Let's go to something else. Let's go find Home Depot. Everyone knows Home Depot. You've been to a Home Depot before, I'm sure. So here you go, Home Depot. Home Depot, last I checked, Home Depot was the 16th largest company in the United States. It's selling for $248 per share, and the market cap is $266 billion. The PE ratio, which is something that you probably should familiarize yourself with going forward is the PE ratio. It's something that many long-term investors and value investors and growth investors pay attention to. So what does it tell you? Well, it doesn't always tell you exactly if it's a growth or value stock, but it definitely can help. So a low PE ratio stock might be more of a value stock. A high PE ratio stock might be more of a growth stock. For example, Netflix is a growth stock. It's got like a 90 PE ratio. Home Depot, less of a growth stock. It's 24, it's got a PE ratio of 24. It pays a dividend of 2.25%. So as you can see here, when you go and you click an actual stock, you can see what's going on in the stock. And then there's some news, which is fine, that's great. And if you want to click the news, you can read the news. The one thing that is kind of not that great with this app is there's no research. So I would prefer there to be like at least some Morningstar reports, some analyst ratings and things like that. You do get that in Robinhood. Charles Schwab, crazy research. I can go click on this. If I click on Home Depot and Charles Schwab, I will just see like a crazy amount of research, almost overwhelming. And I'll see different ratings of Home Depot with Morningstar. I'll see different ratings with Charles Schwab's ratings. I'll see all sorts of things that the analysts are saying about the stock. You're not getting that in here. So it does, when you're starting out, it kind of is hard for new investors to find out how to buy stocks if you're not able to kind of go through this and like see what the analysts are saying to kind of learn. But just one of my pet peeves about this. If you do want to learn without learning through the app, maybe go on Morningstar.com. And I'll put a link down in the description below so you can check out Morningstar. So check out Morningstar, take a look, and there you go. So take a look at Morningstar. So that price history of Home Depot has been great. The 1-year return is 19.13%. So Home Depot's been doing good. That's price history. Profile, of course, you can see what Home Depot is. Now, you probably know what Home Depot is. However, if you didn't, then this would be a great tool for you to kind of understand what the company is and what it's about. And then it tells you some things like the CEO, the number of employees, the shares outstanding. So this is great and it's important, but if it's a company that you've never heard of before that you're researching, definitely important to see this type of stuff. Okay, so there you go, that's Home Depot. Okay, so where are we with creating our different pie? So here's what I'm gonna do. I kind of told you that I wanted to have VOO as like my main core allocation. So 50% of my pie is gonna stay in VOO for now. Now I'm gonna add, I want 5 stocks total. And then, so I'll have 5 stocks at 10% each. And then I'll have VOO at 50%. So you'll see what I'm saying in a second. I'm just gonna pick some random stocks. We're gonna hit Netflix, we're gonna add to the pie. We're gonna put Adobe in the pie. So now I'm at 3 stocks. I wanna put Bank of America, and I got Coke already. Not Pepsi, because that's a competitor of Coke. That would be weird. Toyota, how's that? Am I at, I think I'm at enough. So I'm gonna hit done. And now I have, let's see, 1, 2, 3, 4. Okay, now I have 5 stocks. And so this is what I'm hopefully getting across to everyone. Your pie has to equal 100%. So I have 50% in the Vanguard ETF. The rest of it is going to be equally spread out between the different stocks. So I'm gonna keep 10% in Adobe, 10% in Bank of America, 10% in Netflix, and then 10% in Toyota, and then 10% in Coca-Cola. So that should equal a 50. Oh, wait, save. Okay, confirm. Okay, so now I should have a properly diversified portfolio, and there you go. I have a diversified portfolio. I have my core, which is VOO, and then I have 5 other stocks that I picked, and tomorrow, this will probably go live because I think it usually happens in the morning the day after. So for now, I have to wait, but this is my new pie. This is what it's gonna look like. Now, a very important thing before we go. If you want to basically rebalance this. So let me give you a quick recap of rebalancing here. I'm gonna put something up on the screen so you can see. Imagine that you have $1,000, a portfolio with $1,000. Now let's say you have 50% of your money in that VOO ETF, but the other 50% of your money is in a bond ETF. And so stocks have a great year. And let's say that VOO has a 20% increase. So now suddenly the portion of that VOO is much higher of your portfolio than the bond part, because let's say the bond only made like 5%. So what you want to do is to keep the same risk. In order to say that I always want 50% stocks and 50% bonds in my portfolio, you need to rebalance. So what you need to do is you need to sell the portion that's inside the VOO, inside the stocks, and now put that portion into the bonds, so it goes from that skewed portfolio back to a 50-50 portfolio. So that's what this rebalance button does. So if you see, I'll just hit that rebalance button and it says rebalancing available because basically it's not set up yet because everything's still processing. So there you go, rebalancing, very important. Finally, there's this new thing, it's spend. So I have not checked this out yet, but it's an account, I believe it's a cashback account. So it's like basically a bank account, and it has good percentage rates of rates of return, good percentage interest rates. I will caution you that this is very likely a promo. So will this be going on in a year or two? Probably not. I could be wrong. But very likely that it's just a promo, and if you want to get in on it, great. But just remember that maybe in a couple years, the interest rates probably won't be as high. So there you go, that's spend. M1 transfers, if you want to transfer money from a different account, you can go ahead and do that. Borrow, if you want to buy stocks on margin. I'm not going to actually talk about this because I don't think you should do it. Especially if you're starting out investing, doing this can really mess up your ability to make money, and it can really backfire. So I would suggest, if you're new to investing and you've not invested before, make sure that you learn how to invest first and have a little success with it, and definitely know what you're doing before you go ahead and buy on margin, basically. So just some words of caution, okay? Finally, you have research on the end. Okay, so in the research tab, honestly, not much going on research-wise. Really, it's more like news. So if you're looking for somewhere to aggregate news, okay, this is fine. You have CNBC and Forbes and things like that. But when it comes to research, it's just not here. You're not gonna get much research in M1 Finance, unfortunately. Again, suggestion, if you wanna find some research, maybe Morningstar is a place to go look. Morningstar, or if you want to like open up a Charles Schwab account as well. Great research on Charles Schwab. You have access to a lot of different things. So I wish this was better. Hopefully in the future they'll have some third-party tools for us. But right now it is what it is, and this is what we got. So that's it for research. You can, by the way, if you wanted to, you can like type in stock. Okay, fine. I'll just show you real quick. Like Chipotle, for example. You go to Chipotle, and it's basically the same exact screen that you see when you're looking at and trying to build out your pies. So basically that's what you get here when you search for a stock, at least. So that is it for research. Okay everyone, so that's all we have for today. Thanks for watching. If you like this video, please make sure you hit that like button. It really helps me out, apparently with the algorithm. And then if you subscribe and you want to see more of my content when it comes out, greatly appreciate that. And I really hope that this tutorial helped you learn about how to open an account. I hope you now understand how pies work with M1 Finance, and maybe you have some ideas about how to build out your portfolio. And by the way, please leave a comment in the comment section below. Let me know what you think of M1 Finance, if you're liking it, if you're using it. If you're using any of the expert pies or anything like that, I would love to hear it in the comments. And so that is all we have for today. So thanks everyone so much for watching, and hopefully see you in the next video when you click it on the end screen.